Have you ever found yourself in a position like this, where there are multiple zones to buy from and you're not sure which one to use for your trades? This can be confusing, and if you don't know how to work out which zone is the highest probability, you'll take a lot of losses and you could even miss the wins. So in this video, I'm going to teach you all about the theory of inducement and how you can take advantage of it to win instead of lose. When the market is moving in a clear trending direction, in this instance bearish in a downward trend, sometimes there's going to be more than one zone to pick for your shorts. So in these instances, this is where inducement zones come up. For example, here we have the inducement zone, which is the red box, and then we have a true zone, which is this green box. Now basically, an inducement zone, or inducement as a whole, is just a trap. It's an area in price that looks good for an opportunity, but often won't hold. So this inducement zone here may entice or induce sellers to enter the market when that level is met. So you may see this zone and look to go short here. But what happens a lot of the time is these inducement zones are not respected. And instead of actually reacting from these points, the market will lead through, trade towards the true zones, and then follow through with the larger movements. Now, the reason that this happens is down to liquidity and imbalance. So an imbalance is an open price range, meaning a supply zone like this that hasn't yet been retested. Now, if the price movement had pulled back up and retested this supply, well, then this zone would be a good one to sell from. But because we have this imbalance left open, there is a space here where there is liquidity. So there will be stop losses from sellers who are looking to take positions here. There will be buy stops for buyers who are looking for a breakout trade. And there is also going to be a significant number of orders situated in this area. And these orders are from institutional participants. The reason we know that is because the market movements that we see are generally driven by institutions. The large movements that occur don't come from retail volume because us as retail traders, the trades we take are simply not large enough to actually drive the market in the way that institutional orders can. So because of this imbalance that's left open, and because of all the liquidity that we'll be collecting within this area, as well as the orders situated in this area, we have a pretty good understanding that the market is unlikely to respect this level and will instead push up to fill the higher area. A push through into this point would fill all of the orders situated in the higher supply zone, and it would also fill all of the orders situated in this imbalanced price region, or the liquidity above this swing high. Now, a question you might be asking is, can't we just place a sell limit here and also place a sell limit at the top zone? Because this way, it doesn't matter which one it goes to, we will get triggered into our trade. Now, the problem with doing this is if the first zone does not hold, and then the second zone does not hold, you haven't just taken one loss and then a win. You've taken two losses. So if there are 2, 3, or 4 supply zones in a downward movement that you're looking to sell from, you should absolutely not sell from every single one because you can get yourself in for a 2, 3, or 4% loss in one day, which is not good. So what we can do is use these tricks and use our new understanding of inducement to make sure we are selling or buying from the prime points. So now I'm going to take you over to a real chart example and show you what inducement looks like and how to take advantage of this and some of the intricacies around trading it. Okay, so taking a look at this leg of price action just here, we can see there are multiple zones that we could potentially buy from. So clearly we're in an uptrend. We're forming these higher highs and higher lows. That means we only want to buy. But there are multiple zones that could potentially form the reaction we want to see. There is a demand zone just here, and there is also a demand zone a little bit lower down. Now there's also then another zone at the extreme, which is going to be this zone down here. So what I'm going to do now is run you through the inducement concepts and the intricacies surrounding it so that you know which of these zones to pick. So if you were looking at this market, which of these levels would you look to buy from? Would it be the extreme? Would it be the midpoint zone? Or would it be this top zone here that we've got? Well, first of all, we can start by writing off the top zone. This zone here is not going to be good for a reaction. And the reason why I believe that this zone is not good, and the reason why I would not be trading from this zone, is because we have clear imbalance beneath this level, leading us in towards this demand zone here. So with the imbalance that we've got just here, we can immediately say this is going to be a low probability zone to buy from. So we can eliminate that one completely. That leaves us with this one here and the one at the extreme. Now, which one do you think that you should trade from? You may be thinking it's this one, the low one, because we've got some more imbalance. Underneath this level here and above into this level here, there's going to be a pretty much area of imbalance that the market could be drawn through. But this is where one of the intricacies comes in. This is where one of those interesting points that you can utilize to take more winning trades takes place. So if we look at the structure of this market, we've got a low just down here. From this low, we came up and we formed a higher high at this level. We came down, we formed this higher low. We came up then and we formed this high. But this is not really a viable higher high because the market only wicked through this level and then rejected. So what we actually saw here was a push in from selling pressure. We actually saw the market rejecting higher prices at this point. Now that means that this zone was not really strong enough to break the swing structure. Now, yes, it did break some of the internal structure, so we could view this as kind of a lower time frame shift just here within the trend. But you can see that this previous high that we need to break in order to continue the trend failed to break. We had rejections instead, and the market sold back off. Now, after coming down to this low, we then had a drive up, and this drive up takes us to this level here. This level here is going to be our next higher high. This is the valid higher high, not this one, because this one was rejected. So this gives us a clearer picture as to which of these zones is going to be best. Now, when we're looking at demand and when we're looking at supply, we are always looking to see which levels these demand and supply zones are able to break. This demand zone here at the low didn't actually manage to break into a new structural high, which tells us that this isn't a significantly strong zone. The market had to pull back and reaccumulate before it was able to break the high. And it was this area here that built the strength needed to actually push the market into a new high in the trend, which took place just up here. Now, with this information in mind, that tells us that this zone in the low is not as strong as it may have first appeared. But this zone here in the middle of the range is going to be the stronger zone. So at this point, we can also eliminate this zone. Now, what we can do with this zone is keep it in mind, because if the market is able to break lower and our true zone does fail, it can still be viable for an opportunity if we were to get the right confirmations coming out of it. Because as we saw, it did break some internal structure, but it's going to be considerably less important than this zone because this is the zone that built the strength to actually break the higher time frame structure or push past this previous high. So with this in mind, let's eliminate this zone too, and now we can focus on what we have identified to be the true zone. What we're now expecting to see is this demand zone here pushed through and broken because this is the inducement zone. But we're also not expecting the market to come all the way back down to this low because the real strength to continue the trend came from here. So what we would now be looking for as a trading opportunity would be a push down and then a push away from this demand. Now, if we want to play safe, and I love doing this, I love recommending this, and this is kind of the way that I like to trade, I would use confirmation here. So what we would look to do is once the market comes into this area, we would go to a lower time frame and we would look for a confirmational shift on those lower time frames, which basically means we want to see the low time frames move from lower lows and lower highs into higher highs and higher lows. And when this takes place, this is what validates our setup. The market has now came into the true zone. As we're on the hourly, we're going to go to the 10-minute to identify our confirmations, our reversals. We could even refine down to this little area here, which is where we would want to be buying from ideally, and where we want to see this market reverse. Now, we've seen a small push through, but after the small push through, we had a significant drive up in momentum immediately. So if we take a look at this on a 15-minute time frame, we will see that this was a major wick rejection, meaning once the market came and swept the low, we had an immediate drive up in bullish momentum. Not just enough to form a pin bar, but also enough to actually form a new break-in structure, which would be this lower time frame structure. This high just here is broken, and as you can see, the market's closed above. So on the 10-minute time frame then, what we could do for this confirmational entry is actually mark out the demand here. The demand for me is always going to be the last candle before the impulse. And now this would be the point that we look to buy from. So our buy orders would go on this level, our stop loss would go below the low, and then our targets would go up to previous highs because we're looking to continue this trend upwards now that we've identified the best zone to buy from. So all things considered, here is our setup. And just to give you the rundown once again, if we take a look at this trending movement, we had this inducement zone, which was our core higher time frame inducement zone. And then there would also even be smaller movements to consider as well when you're here on a refined time frame. So this area and anywhere above this area is no good because we've identified this clear imbalance below this point. And then the reason we don't want to go lower, as we've said, is because we know this is where the significant strength came from. So now we are left with a high probability position. We'll jump up to a slightly higher time frame and allow this market to play out. As you can see, we get a drive right up and trade into new highs, continuing the trend and putting us into higher price action. And now you know how to identify and trade inducement. Make sure you're always looking for those strong zones. And make sure you're considering imbalances in the market because the liquidity that's situated in these areas is likely to be driven through. Instead of taking losses at this area, like you may have in the future, now you can trade with the knowledge and the confidence to wait for these areas to be swept, wait for the reversals in the true zones, and profit from those movements. And just so you can see as well, here is a markup that I sent out to my team in one of our overview videos. You can see that although this is a hindsight trade that I'm breaking down, it is something that I called in real time. I hope you enjoyed that video. I've got a free 7-part video course in the description, or you can check out this video next. Thanks for watching. I'll see you in the next one.